SMF MMTs, we just finished a quadruple witch on Friday. 12/18, the third week expiration has completed its cycle and its course. Tomorrow morning is going to be a new trading week. And what we're going to take a look at very quickly, we're going to run through it, is how the 570 put, they took 69% out of it. And that was out of the money below the market. So 93% out of the 580 put because Google closed at 590.80. So here's the call. They still stole premium out of the calls on Friday. They ended at 1120 was the last print. That 590 call ended up at the last print at $1.60. They took 51% out of it. Okay, the low was 40 pennies and the high was 285. What a great trade that was at the market maker wholesale price. 610 call, kiss it goodbye. 90%, all the premium is gone. The open interest in that contract was 5,900. The Google 640 call for 12/18 expired. 80% of that gone up in flames for the expiration. Okay, so these are some of the calls. The 580 call there, we start getting into 122, so I'm going to erase these right here. And we're going to be focusing on the 580, which we own, that 600 call. Earnings are coming, we're going to watch what these prices are as far as, are they deflated calls or are they inflated puts? Once we figure out that MMTs, then we'll be moving on in that price structure. Part of this video was to let people see so far on Apple what they did was on the put side, the $300 put, that went worthless. That's right here, open interest. It was 22,000 contracts gone up. That $300 call, you can see where that ended. $20.70 is the last print. Open interest for December was 87.88. The 310 call, which was in the money, only had a value of $10.60. Total volume traded on the day was 6,400, but total open interest was 19,000. The put side of the 310, now here, you want to talk about one that only went to a penny? It did not go below it. And there was 26,000 open put contracts for December there. The 320 call, which still had a loss, they were only worth 52 cents on the last print. Total volume traded 39,000. Open interest was 30,000 prior. And those were all very deflated because Apple only closed at 320.61 on the day, the name. How about that? Here's the 320 put. On the other hand, you got no premium because it went worthless and there was 23,000 contracts gone. Oh, by the way, MMTs, now that we've seen that, I'm going to take this out of here. Bzzz, and I'm going to go to the turbos and I'm going to go to Apple AAPL and we're going to start loading now. MMTs. Say MMTs. I'm going to go to that 122, that third, not weekly contracts, and here we go. We're going to spin that doctor, and the thing about it is we're going to start at the 320 call. We're going to start at the 320 put. We're also going 310 put. We're also going to go to 310 call. We're going to load this baby from 300 to 300. And this is all January. Now one of the things that we're going to do, and I'm doing it all naturally right on the fly, very quickly. I know what I'm doing. I'm going to that 340. I'm also going to take that in the money 340 put, which is 20 handles above the market, just because I want to know where that is. Up and out of the money 330 call with the 330 put as well. 320, 330 call and put spread. Percentage wise, we're going to be coming up with the pricing control. What I am going to do for a premium trade is I'm going to start taking a look at the cheaper 350 call up in there. I'm also going to take a look at that 3065 in the money because that premium put will come down in value, and it's $1.57 up, and that's 30 handles up and out of the money. But we're going to watch these pricing controls. So as we do that there, we've got these strike prices, 350, 40, 30, 20, 10 down to 300 going up the chain. MMTs, we'll go over these individually. MMTs, we're going to go ahead and open up this Netflix box just so that you can see where Netflix was. Boy, what a treacherous expiration that was. Let's take a look up here at that 190. Let's start here. The 190 call, worthless. Open interest, 10,000 contracts. Here, take a look at the put side, though. Closing at 7.95 plus 7.5. So the net change was still down, though. Total open interest 7,217 traded, so we're going to be watching that one. Here's the 180 call right here. The 180 call, look at that. Last print $1.50, 46% they took out. Here's a $180 put option. It didn't close below that. Yes, it did get at one time below it, but on expiration they got blown out of the water. 2 pennies on the 180 pit. On the 175 call, on the other hand, they still took some premium out of it. 2,300 contracts. Last print, $6.95 on that 175 call. 175 put. Sorry, didn't go below it. It's worth a penny. 7,400 open contracts chewed up. The 170 call, still 1175 is the last print. They were worth a buco lot of money at one time. The low was 1074. The high was 14.5. 2,500 open. That was the actual low and the high of the expiration there on in the money. Out of the money put, well, forget about it. It's zero. So basically what we're going to start doing with Netflix is we're going to take out all of this scenario right here from the 190 down, and we're also going to load that. Now that we have done that, we're going to go to the Netflix. We're going to go to that turbo. We're going to load this turbo up, and we're going to start at where Netflix actually closed at what price? NFLX, last print was 180. So once again, we're going to get back into here. 180. We want that 180, 180. Okay. We're going to go with the 200 up and out of the money. And we're going to follow that 200 put. Because if that 200 put's going down in value, you're going to gain some premium here. Then we'll start getting into what it looks like at the 170 put and the 170 call that's in the money, so we can take a look at those ratios. That 175 on the hip, 175 put. Okay, so where are we starting at here is 122. We're going to do that 190 because it's important. That's $10 above the market, and benchmarking that ratio between that 190 call and put spread, and where the inflated and deflated pricing zones end up coming in. So that's what we're going to do for Netflix. We will take a look at one call for a volatility hedge, and that's going to be the 220 up and out of the money, and more importantly is the 230 up and out of the money. And that way, if we're short Netflix and we want a heavy volume hedge up and out of the money, we'd be buying that for any big gaps because of the volatility in the name. Here we are taking a look at that first solar trade. These were wild prints. You can see here, let's open that baby up. You can see that open interest on it here for the December expiration, 12/18 right to here. So when we look at the 145 put, they were up pretty big, plus 28% there. If you take a look at the 145 call, well, I'm sorry, that didn't do it any good. The actual closing price was 133.25. They reported an earnings report on First Solar MMTs, popped that thing up in pre-market after hours to 142. What a great short that was, pulled it all the way back. So basically they took a haircut on these Netflix. Let's take a look at the call option here that expired. That's 130 call in the money. You can see where the high was 560 and the low was $2. So basically you expired in the money on First Solar by $3. But let's take a look at the 135 put in the money. They didn't give it. You got a lot of premium because the low was 77 cents on expiration, and bam, 350 you went. All right, let's take a look at the 135 call, which expired at 5 cents, down 96%. Whoa, whoa, whoa. The high was $1 and they expired at a penny, and that's what they do in options expiration. The 140 call at same thing, and that 140 put though on the other hand plus 74%, 490 was a low. Look at that high, 8.11 ratio on the 140 put. It closed in the money. That 145 call went all the way goodbye. That 145 put, once again, that 145 paid throughout the whole process, 10.05 to 12.99. It doesn't matter. It was a very cheap contract at one time. So we're right now going to end what was happening here, MMTs. And I'm going to go ahead and delete. I'm going to delete MMTs. And basically, we got a 140 put and a 140 call. I'm going to go to the turbo, and we're going to turbo up for solar FSLR. We're working quickly. And then we're going to do all the pricing structures, all MMTs. We're going to go to this expiration right here, which is 121. And basically, we're going to line the 121 expiration. No, 122 to 11, that's 12. So I'm just looking how many trees they have. And so they got March, and then from there they pop there. Then from that time period, they pop there. So throughout 2011, they will be doing more of these. I'm just looking through the differences there. Let's take that 130 call. Let's take that 130 put, but more so, here's the 125 and the 125 below. The 135, which is the top, and the 135 there. Let's throw in that 140 put, which I believe we already have, so we can benchmark. If they take this ratio premium away, we're going to get some added to the 140 call, which we have in there, and they're up and out of the money. So we're well adjusted right here. Let's go to page, save. And First Solar is a different type of instrument here lately. It had a great earnings report, but they really shook it down. But just remember, MMTs, they're the ones that can bounce. So those were the options expiration quote prices.